following paid commercial program is brought to you by TD Wealth.
Hello and welcome to Money Talk. I'm Greg Bonnell sitting in for Kim Parley. Equity markets have been shaking off concerns about high interest rates and a potential recession. In fact, stocks continue to march higher this year. But my next guest says now may be a good time to take a closer look at fixed income, especially in the coming quarters. Anna Castro is Senior Portfolio Manager at TD Asset Management. Anna, it's great to have you back on the show.
Thank you. Happy to be here.
Let's talk about this then. Let's talk about the effect that higher rates are starting to have on the economy. We're seeing some of those effects and what it could mean for the markets.
So you're starting to see the economic growth momentum slow down. You're seeing consumer confidence slightly weaken, retail sales growth to be lower than they were before, as well as manufacturer activity, mainly because it's now more expensive to borrow and it's also harder to borrow.
So this was the intention of the central banks when they raised rates so aggressively on us to try to cool the economy, bring inflation down. You have some charts that highlights what you're seeing out there from those efforts.
Yes, good point, Greg. I do want to mention when you said we've been here for a year, technically it's only been 6 months since the summer wherein rates were higher than they were in the prior cycle. So it's taking time to flow through. So the chart we have here is our spider web of various indicators. Obviously, a market bottom is not an event that you can call, but a process. And so I'll go through some of the metrics. The ones on yellow are, for example, inflation. It's lower than it was in the prior year, so we're seeing it move to closer to 4%, but certainly below what the Fed is targeting at 2%. The other portion is valuation. We believe equity valuation is too high, especially relative to where fixed income yields are at. And then the third one is risk sentiment. We do think that the equity market specifically is quite positive or optimistic in terms of the outlook, especially if we think that this economic slowdown is only in the early innings, and we might see more of that manifest itself closer to the summer and towards the end of the year. And the indicators here as well, you see the red circles. So we do see that earnings revisions have been guided down. So they're slowly being revised lower. So that's a good sign, more realistic expectations. But it's still a question how deep this recession would be. The other component is growth. We do see, as I mentioned, economic growth indicators weaken. And if we think that we're just still in the early innings, we expect that to further weaken in the coming quarters as the lag effect of higher interest rate and tighter conditions show itself. And that's why we're concerned about what equity markets are pricing in versus fixed income.
Okay, given that, then let's talk about fixed income. You say it is the time to take a look now, especially U.S. government debt. Walk me through that.
So long-term U.S. government debt, that's like 10 plus years, 10, 20, 30 years, are offering around 3% income yield, which we have not seen in the past 15 years. So that by itself is attractive. But more importantly, these long-dated U.S. government bonds would benefit or appreciate in value during an economic slowdown. So because when inflation expectations go down and economic growth expectations slow down with worries about recession and flight to quality, long-term government bond yields go down. That means government bond prices go up. And so they would appreciate in value. And in that setup, U.S. long-term government bond on a risk-off setting can offer you double-digit type of returns in total returns and highly liquid to help you adjust your portfolio if the market conditions change.
Now, when someone hears U.S. government bonds, they might think, if they're following politics, the U.S. government wrangling about the debt ceiling. How concerned do we need to be about, what's happening with the debt ceiling and where we might end up if we're investors?
So overall, the U.S. debt ceiling this time around is more concerning than it was in the past. Like in 2011, you had a risk-off response in the market and equity markets sold off. On a relative basis, U.S. long-term government bonds would appreciate in value and benefit from this setup because there would be a flight to safety. And again, if you have a prolonged polarization or debate on the U.S. debt ceiling, the longer this is not resolved, the more volatile it is and the more negative it is in economic growth. And that would actually mean that lower economic growth expectation is positive for U.S. government, long-term U.S. government bond yields.
All right, so that's the case for fixed income, but you're also, when you talk about portfolio management and allocation of funds, not saying no to equities. What does an investor need to be mindful, though, in times like these if they're taking a look at fresh equity positions?
So it's all about focus on quality. So U.S. government bonds provide quality sources of income and optionality. Equities and alternatives are not bad places to be as long as you're focused on quality, resilient business models, quality assets, and again, quality sources of income that can handle different types of the economic cycle.
Now, when we talked about the fact that, of course, we've been living with these aggressive interest rate hikes for a year now, and we're seeing it starting to flow through the economy, we think about the labor market, we think about a lot of the things you talked about, consumer retail spending. We're seeing some stress, very specific to some U.S. regional banks. That story hasn't gone away. The Fed did suggest that could do a bit of the work for them in terms of tightening credit. How should we think about those events?
That's a good point, mainly because small and medium businesses rely a lot in terms of their sources of credit from regional banks. So the challenges in the regional banks, while it's not a contagion, makes it not just only expensive for businesses to borrow, but harder for them to borrow. And that has implications on their capital spending, as well as their ability to continue paying their workers or increasing their worker base. So there has downstream implications there. Overall, difficulty in credit, more expensive credit is not good for the economy longer term, but it takes time to play out. And that's why, going back to my point earlier, it'll be a couple of quarters for us to really see the impact on the broader economy.
Before I let you go, I just want to ask you, what are the risks to the thesis about, some value in bonds going forward, given everything that's happening, everything that may happen?
So the main risk there is another inflation shock that throws off the current trajectory of the moderating pace of inflation.
Anna, always great to get your insights. Always great to have you on the show. Thanks for joining us.
Thank you so much.
Anna Castro is Senior Portfolio Manager at TD Asset Management. Anna's colleague, Michael Craig, will be our guest next week on Money Talk Live. That airs weekdays at noon on TD's web broker platform. And here are some of the other guests that we'll have appearing next week as well. You're watching Money Talk.